This is Kali Arevalo, editor of Institutional Investing in Infrastructure. We're going to talk about the implications for the preference for proven managers versus new entrants. It's a phenomenon we've been hearing more about. And today I have Chris Haines, a principal at Hodes Weill Associates, to walk us through it. So, welcome, Chris.
Thanks, Callie. Yeah, looking forward to it.
Yeah, thank you for being here. A couple of months ago, I know Hodes Weill and the Cornell Brooks Center for Infrastructure released the 2026 Infrastructure Allocations Monitor. It's an incredibly comprehensive annual report. We always pick it up. We love to cover it and talk about it. And that's for institutional and infrastructure investors. It's very useful, lots of good information. We were fortunate enough to have you give a preview of this data at our VIP infrastructure event in June. But just for those who weren't there, can you just give us a high level sort of overview of the report? What is it, and how do you guys find the information?
Yeah, sure. Um, as you mentioned, we've run this survey or monitor for a couple of years now. This one is actually our fourth annual issue of the report. We do it in conjunction with the Cornell Brooks Center for Infrastructure. We've run a similar report on the real estate side for quite some time as well. What we do is we really seek to establish the most comprehensive annual assessment of institutional allocations to and objectives in infrastructure. And we do that by surveying the institutional investor community. So we devise a survey that's, just north of 25 questions that covers portfolio allocations, current and future investments, returns, conviction, investment management trends, and a couple of other items. And we'll go out and survey about 1,300 institutions. We typically pick up around an 11% or so participation rate. So our survey this year encompasses 142 institutions. That's from 26 countries around the world. And the full survey represents just north of 11 trillion of total assets, and more specifically, right around 600 billion of infrastructure assets.
Perfect. Thanks for the context of the report. And there's so many compelling highlights, but just one interesting thing I found was the discussion on institutions expanding manager rosters while becoming sort of less willing to back new entrants. Can you explain the findings surrounding this a little bit and what factors are contributing to this?
Yeah, sure. And I think to set the table more broadly, we've seen generally across all of real assets somewhat of a consolidation of investors wanting to do more with fewer. So that's both consolidation on the kind of platform side as well as around new commitments. So this isn't necessarily a new phenomenon, but it's something that we saw highlighted a bit more year over year. I think we've seen, almost three-quarters of institutions report being very unlikely or somewhat unlikely to invest with a first-time manager. Um, but they are looking to diversify their commitments across managers. I think we had several institutions write in how important manager diversification within their portfolios are. So it's something that we're seeking to monitor and unpack a little bit more as we're in the market speaking with institutions.
Yeah, thank you so much. And thanks for pointing out it's not necessarily new. But we've been hearing about it certainly at our events. So as I understand it, as capital is allocated to proven platforms instead of new entrants, this could accelerate the consolidation of the industry, like you said. Why is this significant? What are the sort of implications of that?
Yeah, I think the implications of this, broader manager consolidation is, pretty robust in that you're going to have fewer managers attracting more of the capital. And as we've seen a proliferation of new infrastructure sponsors, an expansion of strategies within the space, I think infrastructure managers, newer on in their fund series or with less of that kind of proven and attributable track record, need to get more creative both in the structuring of their funds or investment vehicles and in the breadth of who they're approaching to help capitalize them early on. I do think it's important to note too, while some of our takeaways are on a global scale here, if you look into the data, there is some willingness and green shoots for investors looking to um, expand to first-time managers or are willing to back first-time managers. I think historically, and what we've seen in the data come through, you've got reluctance from both the private and public pension side, which I don't think should be so surprising. Endowments and foundations are really the most receptive segment in the types of institutions that we survey for their likelihood to consider kind of this platform level risk or a first-time fund manager. I think beyond that, if you look through to geographies, you'll see that capital is concentrating at the top of the market with these large diversified platforms and multi-strategy products across the board. But really, where you're seeing kind of, middle market or new managers find most success, it's among US institutions. And so you are seeing that kind of US market, both for strategies ex-US and within, be more open to kind of a first time or potentially less proven from a track record perspective strategy than institutions ex-US.
I think that's really interesting. And why is diversification, Chris, so important today? Like you mentioned, there are a good segment that feel diversification is important, especially with new managers. Why today? What can that offer?
Yeah, sure. I mean, I think regardless of the date, diversification is always going to be an important tenet of one's, institutional portfolio. I think something that we're seeing today is investments ramp both from a capital and just size perspective. Specifically, think some of these projects to underpin the growth of AI or energy. You're seeing these larger investment sizes consolidated among fewer and fewer groups. And I think there's an increased pool of capital that might be rounding out to kind of chase and participate in these larger kind of top of the market deals. When you're looking at exposure across the gamut, specifically in this lower middle market and middle market region, many times you're going to need a fund that is better positioned to access those deals or a team that's better positioned to access those deals to provide proper diversity within what's going on in the market. And so I think we've seen institutions become far more receptive, open, and even in search of opportunities that fit this, middle market zone that are taking these deals that might in turn exit to some of these larger funds or have different kind of paths for growth go forward.
Absolutely. And I mentioned we've been hearing a bit about this at our VIP infrastructure event and our editorial advisory board. And something I asked the board last year was because the topic had come up the previous year about this being just a challenge that the industry is facing. But I asked if that was still top of mind, kind of where we're at now. And this was the end of 2025. This was in November. But
Mhm.
I heard that, there's been a bit of movement. Some attendees said some first-time funds were easier than it used to be to invest in, and the environment seemed to be sort of loosening up with more capital flowing into these funds. What is your take on that? And what do you think looking forward to the next couple of years, just based on what you guys have heard? How do you see the industry changing or staying the same, or what are your observations?
Yeah, look, I think from our seat, we'd echo those observations as well. I think there is continued dry powder, and institutions remain underallocated to infrastructure, and they're looking to make commitments. Our survey found that, you know, nearly 40% of institutions expected to increase their number of infrastructure managers in institutional portfolios. And that's a meaningful way that they can start to close this gap between current and target allocations in the coming years. I think as we're seeing some of these, um, shifting focuses of strategies, the continued growth of, AI and the energy to support it, and this, in some cases, convergence of, infrastructure and others to help capitalize this opportunity. We'll continue to see, new strategies pop up, other managers and newer entrants come into the market with different angles, track records, or things to offer to capitalize on these opportunities. And I think we're generally energized by the prospect of these new entrants of the opportunity to scale kind of platforms to continue to capture new opportunities that are coming down the pipe.
That's great. Well, I appreciate you again joining me today and talking about this. I think it's a really important topic, and I guess we'll kind of keep an eye on it and see how things play out, right?
Yeah, yeah, no, absolutely. I think it's a really exciting time in the infrastructure and especially the capital formation space. A lot of exciting things going on.